It exceeded expectations on the top and the bottom lines, and its shares popped 5% in extended trading. Well, Angelo Zino, he's SVP and head of technology at CFRA Research, joins me now. Angelo, always great to see you. And look, traders setting this stock higher by about 5% in extended trading. What did you like in Google's report?
Yeah, so thanks for having me, Kristen. When we look at the results, I'd say the biggest unknown or concern going into the print was the ad spending side of things. And that really held up pretty well, both on the search as well as YouTube figures, where we saw a growth of about 10% on both sides. And then you look on the cloud business, and that segment grew about 28%, which is where we expected it to. So for the most part, the numbers look like they're holding up fairly well. They're being very resilient. And more importantly, maybe in terms of the beat, was what they're doing on the bottom line. And this is a company that historically has executed extremely well. They continue to do that. When you look at the operating margins at close to 34% this quarter, it was well above our expectation, and helped the beat on the bottom line. So the combination of steady top line numbers as well as good execution on the bottom line is really what we think is driving positive investor sentiment here.
Angelo, any indication as to how Alphabet will be able to navigate this environment ahead, of course, a volatile market, tariffs, and an economy and a consumer that seems to be slowing?
Yeah, no, I think that's the fear right now, is ad spending will eventually get hit, right, as we progress through the year. I think the positive, at least from the perspective that we're looking at, is at least Trump is kind of walking back some of the more aggressive policy stance that he had just a couple of weeks ago. And the hope is, as maybe some of the numbers start deteriorating from an economic perspective, maybe he even kind of pulls back even more. But as far as the situation stands right now, Alphabet has historically been a lot more resilient than the other digital ad names and other kind of ad-related names out there. And we expect that to once again be the case here. We expect them to kind of focus on the bottom line if things really start hitting on the top line. But ultimately, listen, if macro starts to roll over, there's no company out there that is immune to that. Especially, and Alphabet is no exception. So there is risk to the call here, as far as kind of looking here over the next couple of quarters from a macro perspective. But Alphabet should hold up better, and it historically has, because of that search business.
Interesting. So, Angelo, it sounds like you're sticking put with your call for now, but anything else to note here in Alphabet's results before we look ahead to next week, because we'll get 4 Magnificent 7 reports on tap next week?
Yeah, I mean, listen, I think it was great that they continue to defend the stock. They announced the new $70 billion buyback plan, increased the dividend by 5%. One of the positives with Alphabet is the fact that they have such a strong balance sheet. They're also making a very notable acquisition on the cybersecurity side of things. So, free cash flow continues to be very strong, and I think that's kind of a really important part of the story here.
Interesting. So next week we will have Meta and Microsoft, those Magnificent 7 companies, reporting on Wednesday, Amazon and Apple on Thursday. Anything in particular, Angelo, that you're looking out for when it comes to those results?
Yeah, listen, I think Alphabet kind of gave good indications on what we should expect on both the digital ad and cloud side of things. So, it's a good start to earnings season for the other, Mag 7 related names. I would say, we want to continue to see what the outlook in terms of ad spending looks like from Meta and Amazon. On Meta side of things, they are going to be a little bit more exposed to some of the China retail providers out there, the Sheins, Temus of the world, and we know they're sharply pulling back spending. So we want to see what the impact there is for Meta. Meta is probably the most at risk to seeing consensus earnings cuts, we think, as we progress through the year. So keep an eye to what they have to say in terms of Q2 guidance. Mm-hmm. And then on the cloud side of things and CapEx side, we expect all these companies to sustain capital spending plans, and that will bode well for the chip makers. But we want to also make sure that cloud revenue continues to hold up very well. But from what we saw out of Alphabet's numbers, we think cloud is going to hold up pretty well here over the next couple of quarters.
Let's talk about artificial intelligence, because these companies are investing billions of dollars in that technology. And of course, that technology runs on key components like semiconductors. How do you anticipate that AI and the spend there may or may not be impacted with everything that's going on right now as it relates to tariffs?
Yeah, so in its current form right now, over the next kind of 2 to 3 quarters, we think that AI spend will remain relatively unchanged. And the biggest reason for that is just the opportunity looking ahead is just way too great for these guys to really cut back on spending. Not to mention, they've already got certain spending plans put in place that they're not necessarily going to want to pull back on. Not to mention, on top of that demand on the AI front remains extremely strong. So you're going to want to continue to invest in areas that are working in a market that could be challenged here over the next couple of quarters. But what I would say as far as the risk is concerned in terms of AI spending is keep an eye on the digital ad spend. Because what happens is if we continue to see sharp deceleration on digital ad spend as we progress through the latter half of the calendar year, there is going to be downside risk potentially to 2026. And I think that's the big concern in the market right now. And we want to ensure that doesn't necessarily happen. But right now, it looks like we're okay from the spending side of things.
What would cause that to change in terms of perhaps a retesting of that particular level?
In terms of CapEx spend?
Yes.
Yeah, I mean, listen, I think, again, the biggest risk to us is on the CapEx side of things, is on the digital ad side of things. I think other concerns out there is we get too much growth on the compute side, right? So if we start seeing supply start to significantly exceed demand in terms of compute, with a ton of new players entering the market, right? You've got the likes of Stargate with OpenAI over there, as well as others, whether it be CoreWeave expanding their initiatives. There's going to be a lot more compute entering the market here over the next couple of quarters because of the aggressive CapEx spend that we see. If the demand doesn't hold up on the cloud, then we could potentially see a ratcheting down
Angelo.
of CapEx spend next year.
Thank you so much for joining. Angelo Zino, he's SVP and Head of Technology at CFRA Research.